Welcome to The Explainer. Today, we're diving headfirst into the world of neo-brokers. You know, the companies that have totally shaken up the investment world with that incredible promise of commission-free trading. We're going to look at the amazing access they've created, but also the hidden costs you really need to know about. You know, for decades, the whole world of investing kind of felt like this exclusive club, right? It was guarded by high fees, really complex jargon, and just these intimidating walls to entry. If you ever felt locked out, hey, you are not alone. But in just the last few years, a whole new wave of companies has shown up to completely blow that old model out of the water.
All right, so let's get right into it. What exactly are these platforms? You might hear them called emerging brokerages, and they've managed to put the power of the stock market into millions of new hands. How? Well, at their very core, neobrokers are fintech companies. They basically take the super complicated web of financial markets and distill it down into a simple, slick, user-friendly mobile app. Their whole mission is built on this really powerful idea, democratizing investments. And that just means making the markets accessible to literally everyone, especially a younger, tech-savvy generation. I mean, their growth has been absolutely explosive. So what's the secret sauce here? Well, their massive appeal is really built on two powerful pillars that have attracted millions of new investors to the market for the very first time.
It all boils down to two key ideas. First, making investing accessible and affordable by just tearing down all those old barriers. And second, building a modern toolkit, a whole set of powerful, intuitive features that are designed for a generation that, let's face it, lives on their smartphones.
This is really where the revolution began. We're talking zero or super low commissions, no more crazy high minimum balances just to get started, and a setup process that takes, a few minutes. But the real game changer is fractional shares. This means you don't need thousands of dollars to own a piece of a company like Amazon or Google. Nope, you can buy a small slice for just a few bucks.
And this really gets to the other side of their appeal. It's not just that it's cheap, it's also powerful. The whole goal is this sleek, digital-first experience, and that often includes access to new things like crypto, automated tools like robo-advisors, and even community features where you can see what other people are investing in. It's an entire ecosystem for the modern investor, right there in your pocket.
So, you've got a beautiful app, you've got powerful tools, and you've got zero commissions. It all sounds incredible, right? Which, of course, brings us to the big question everyone asks. How on earth is this all actually free?
Well, it's a balancing act. That super smooth, low-cost experience on your phone is only possible because of a fundamental shift in the business model. And the very things that make it so great also introduce this whole complex web of trade-offs, potential conflicts of interest, and, hidden costs for you, the investor.
So to really understand those trade-offs, we have to do one thing: follow the money. Let's pull back the curtain and see how these neo-brokers actually make their cash.
Okay, so neo-brokers have a few ways they make money, like earning interest on margin loans. But the primary engine of the whole commission-free model, the biggest piece of the puzzle by far, is a system called payment for order flow, or as you'll often hear it, PFOF.
Okay, let's break this down, because this is really the key to the whole business model. When you hit buy on a stock, you'd probably think your order goes straight to a public exchange like the NASDAQ. Well, with a lot of these neo-brokers, it doesn't. Instead, they bundle your order up with thousands of others, and they sell that order flow to a huge trading firm known as a market maker.
So here's how it works. You place an order. The neo-broker sends that order to a market maker. And in return for that fire hose of orders, the market maker pays the neo-broker a fee. Now, it's a tiny, tiny amount for each trade, but when you multiply that by millions of users making millions of trades, it becomes a massive source of revenue.
And this is where things get tricky, because it creates a potential conflict of interest. Is the broker incentivized to send your trade to the place that will get you the absolute best price, or to the market maker that pays them the most? That is the billion-dollar question that has regulators very, very interested. And it's not just a theory. It's led to some major finds in the real world.
So the business model itself brings up some fundamental trade-offs. Now, let's dive in a little deeper and see what the specific limitations and new risks are for you, the investor.
These trade-offs really fall into two big buckets. On one side, you have platform and service limitations, basically what you're giving up to get that simple, low-cost service. And on the other, you have investor and regulatory risks, the kinds of dangers that can pop up from a model that's designed to keep you trading.
So if we look at the fine print, keeping costs down has its trade-offs. For example, these platforms often have a more limited range of things you can invest in. You'll also probably find less deep-dive market research, and when things go wrong, trying to get a real person on the phone for support can be a real challenge, and you almost certainly won't get a personal advisor like you might at a traditional brokerage.
Now this is the other, more subtle risk. The very design that makes these apps so addictive and easy to use can also encourage some bad habits. The use of what's called gamification, things like digital confetti when you make a trade or constant push notifications, can lead to more impulsive and excessive trading. It can steer you towards short-term speculation instead of sound long-term investing.
Okay, we've covered a lot of ground here. The incredible access and also the hidden complexities. So after all that, what's the big picture takeaway for you as an investor? What does it all mean? It really comes down to these two sides of the very same coin. On one side, you have this incredible financial inclusion, democratized access, low-cost entry, and powerful modern tools. That is a massive, massive win. But on the other side of that coin, you've got the hidden costs, the behavioral risks from gamification, the platform's limitations, and those conflicts of interest. Look, neo-brokers have fundamentally changed the game, but this powerful shift demands that you understand not just what you're buying, but how the platform you're using actually works.
So, the crucial question is this: what kind of investor do you want to be? Are you in it for the long haul, building wealth slowly? Or are you a short-term trader chasing the next hot stock? There isn't a single right answer, but now you understand the trade-offs. The access might be free, but the choices you make with it, well, those will define your financial future. So make them with your eyes wide open.